Well, Sharon Bell is European strategist, Goldman Sachs, and joins us here once again around the desk. Great to see you there, Sharon.
Nice to see you.
Well, Karen was just detailing the UK data that came out this morning. So you've got a drop in the jobless rate, 3.8%, lower than what we were expecting, and also wages up more than expected. So obviously a bit of a spot of bother for the BOE here. If we do have to see more interest rate hikes here in the UK, what would that mean for the market?
So I think we will have more interest rate hikes given this data, given the data we already had seen coming through, and then the data today I think confirmed this even more. The labour market in the UK is super tight. The inflation data anyway has been sticking in high in the UK, and this is just going to cement that trend really. So absolutely I think more rate hikes. Now in some ways sort of mid-caps, UK domestic stocks, FTSE 250 should quite like sterling going up. It means that when they import goods from abroad, it's cheaper for them, etc. But of course, wages going up won't help margins. The tight labour market is something that companies are always complaining about. So I think those things put together, this is slightly negative, and of course, higher interest rates as well.
Higher interest rates have not been the friend of growth stocks like techs. And yet it seems that the frenzy over AI has overridden that to a large degree. And yet I guess the UK market is one of those markets that isn't particularly exposed, is it, to AI? Is that a good or a bad thing in the current circumstance?
I think on balance it's a bad thing because of course AI has been the sort of productivity champion really. It's our expectation for the next few years that you're going to see an enhancement in productivity.
Unless the current euphoria ends badly, at least short term, even if you're a long-term believer in AI technology.
For sure. There'll be lots of ups and downs and volatility and risk around it. So I guess the UK listed sector avoids a lot of that because it doesn't have a lot of exposure there. But on balance, yes, I would say that that's not helpful either, that UK doesn't really have much of a tech sector listed. It's got quite a lot of a sort of a unlisted tech sector, but the big, large listed companies are very much in value areas like financials, commodities, etc.
Sharon, I'm somewhat confused because there used to be this inverse correlation between the FTSE and pound. So typically every time pound went up, FTSE started to fall. But you point to companies where the imports of the margin story can be protected thanks to the currency. The only one I can really think of is the owner of Primark. That's typically one where you do see some improvement. But again, in a very challenged consumer-focused part of the market, and we've got rates going up, it's not going to benefit. So help me out. What companies are we thinking about? What sectors are actually going to benefit here?
So I think FTSE 100 definitely won't benefit from sterling going up. Generally speaking, FTSE 100 makes dollar earnings. It makes earnings, oil earnings, banks earnings, which are global really for the FTSE 100, huge global consumer staples companies as well in there that make a lot of dollar earnings. So definitely FTSE 100 won't benefit. But FTSE 250 or the smaller cap companies or domestic UK companies, they do tend to, on balance, all else equal, benefit from sterling rising because they're an importer of lots of different goods. It also improves the kind of real incomes of UK households. But I would say that sterling rising is a small offset relative to all the other negatives here we have for those companies. You mentioned the squeeze on the consumer from higher inflation, also for companies the squeeze on their margins from higher wages, etc. So I think on balance it's not super helpful, even for those mid-caps and domestic companies.